Good morning, traders. I've got quite a good treat for you. Today we're actually going to be doing a whole new strategy which I haven't shown you guys before. I've been testing it out for the last 3 months or so, and I've had some very good results both with back testing and testing in a live environment. So now it's time to introduce it to you. We're going to be looking at a strategy called the dual stochastic or double stochastic or two stochastics. It doesn't really matter what you want to call it, but the idea is that we're using two different stochastic indicators with different settings in order to find decent entries for the market. The strategy focuses on trading when the two indicators are showing extreme opposite values, where both the fast and slow stochastics are at or near the overbought oversold limits. Then it signals a trading opportunity. The idea is to use a completely mechanical trading system, which waits for conditions and shows you when the market is likely to continue along a trend. And as we have used a single stochastic before to look for these sorts of things, we've always had other indicators to show the general trend of the market and that sort of thing. So now we're going to be not only introducing a whole new strategy, but a new way of using stochastic to look at the overall trend inside a market. And that's what this whole thing is about. So without wasting any more of your time or putting you to sleep, let's get started with the actual setup, shall we? So we're going to be using two stochastics. So go ahead, load up your charts, get your favorite looking one. In my case, it's this very clean and clear blue and red setup that we have here. And we're going to be adding stochastics. So I go to add indicator, we go down to custom, select stochastic. Now we're going to be having a fast responding one and a slower one. These are the settings we're going to use. On the faster one, we're going to have the K period at 5, the D period at 2, and the slowing at 2. So this will respond very, very quickly. Now we're going to stick to our levels of 20 and 80. Remember, I just set this to black so it's easier to see, but that's up to you what color you'd like it. And let's go ahead and add this one. And now we're going to add our second one. So we go to add indicator, custom, go back to stochastics, go to inputs, and then over here, these settings, we're going to have a K period of 21, which is a lot slower, but it's still not unreasonably slow. D period will be 4, and slowing will be 10. Now this will make a very smooth looking stochastic. Again, we leave the 20 and 80, and I'll set this one to black as well, and click OK. Now you shouldn't have to change the colors of the stochastics to tell which is which. You can see immediately that the slower one and the smoother one is slower and smoother to respond. You can see the fast moving one twitches around very quickly. This one here, it's all nice and smooth, and we're going to be using this to help us determine the larger trend in the market. Now, this strategy does work on many different currency pairs and time frames. I'm going to stick to the euro dollar in 1 hour, which is the one that I've personally had the most success on. So we're going to stick with this one for now, but once you've learned to try it out on some of your favorite pairs, try it on the different time frames. You know, if you want to go for scalping systems, go shorter. If you're looking for longer trades, go for the daily perhaps. But let's stick to the one that I've had the best results on. What we are looking for are the extreme differences in stochastic. This means that we want to see the one stochastic as overbought and the other as oversold, or the other way around. Now let's have a look at a few examples. It is a much better way to explain it when I can actually show you what's happening. If you look at this area of the chart over here, we can see that the slow stochastic is overbought and the fast one is overbought. Now these are obviously not extreme differences, these are pretty much the same thing. But if we have a look over here, we can see that the longer stochastic is overbought and the faster one is oversold. So what this is telling us is the slower, smoother stochastic is telling us that there's a very strong bullish trend in the market. The faster stochastic is telling us that the trend has shifted to bearish, but because it's such a fast moving stochastic and responds quickly, we're using this to pick up the little turns in the market. So in this case, we have two contradicting things. Now keep in mind that generally slower moving indicators are more reliable, but you do get into the trade a lot later. So we're using the best of both worlds here. We're saying that the market is bullish at this point. There's a very strong bullish momentum. Now, for those of you who've traded stochastics before, you'll know that very often when stochastic goes into a oversold territory like this, we expect a bit of a snapback. So with these two extreme differences, this one saying that the market will continue upwards and this one saying that the market is short but we're expecting it to turn, we use this as a trigger. And in this case, let me go ahead and line it up. There are two potential entries here. We are waiting for the quick stochastic to leave oversold, and that's telling us that the market will be turning up. And at the same time, we need the slower stochastic to be in the direction we think the market's going to go. So we've had the market come down. The faster one has gone into oversold, telling us it has moved too quickly in this direction. And the slower one is confirming the bigger trend. And then we see this happen afterwards. We see that it is dead right. It took a little bit to happen. It did leave oversold, went back in, then it left again. And this would have been our entry point, this candle right here. So we would have gone a little bit negative, but then it would have gone up and up and up and up and up, and eventually closed off at well over 200 pips profit. Now let's be reasonable. You wouldn't have walked off with all 200 pips, but out of 200, I don't think it's unfair to say you would have got at least 100 off of that. So that's an example of a long position that we entered. Keep in mind that we want to trade in the direction of where the slow one is saying the bigger trend is. And if we're using the faster one as an indicator, it's telling us that the market should be moving up. So both of these are actually telling us that the market should be moving up. So we're using the faster one as a trigger, telling us this is the point where the market could be turning, and we're using the slower stochastic as confirmation to which direction it will go. Let's go ahead and find a short position just so we can show you the difference between a long, like this one here, where we are buying, and let's find one where we would need to sell. What I'm looking for is for a point where stochastic is oversold, like this at the bottom, and the faster one must be overbought. So in this case, we found a position right here where it came down, and this trade petered out after about 40 pips, which is still quite good. But let's find a better one, shall we? Just so we can show you the extremes of this. Wow. Well, here's a good one. The slower stochastic moved down into oversold as the market trend started going bearish. And then we had a little upswing over here, and the faster stochastic is telling us the market is overbought at this position. It's likely to turn around. And as it goes back into between the 20 and 80 levels, it's showing us a potential entry. So let's go and line that up. That would be the point that you'd want to enter. So you'd be in on that candle there. And just to run through it again, I hope it's not too boring for you. I just want to make sure it's clear. The slower stochastic is telling us the direction that the market is generally moving, the bigger picture. And the faster stochastic is giving us a small little entry point to tell us when can we hop in and trade in that direction. And that's what we did here. Here we see that the market was coming down. The big stochastic has confirmed that, and the fast stochastic has told us that the market should be turning, giving us the exact entry point of this candle here. And as we can see, this one worked out amazingly. We got to 170, it petered out at 228, but again, we can't say that you would have got all 228, but I don't think it's unreasonable to walk off with at least 100 pips on a trade like this, especially since 100 pips only took... Yeah, here we go. 3 hours, you could have clocked 100 pips on this one. So that in essence is how it works. Now, if you want to set and forget strategy, where you don't have to sit and watch the trades, you would simply set a trailing stop on your order. If you're not familiar with trailing stops, make sure that you register for our free online course. It's all discussed in there on how trailing stops work. They do seem to work very nicely with this sort of strategy because we are picking up the times in the market. We're expecting a very fast movement, and we kind of want to be in and out that trade. We want to make our money, cash it, and enjoy the rest of the day relatively stress-free. If you have any questions about the strategy, please go ahead and post comments, especially on our Facebook page, just so we can interact with you guys and find out more about what you want to learn about and how we can help you.